Hi, everyone, and welcome to our weekly webcast, the one we call ChanceTALK. I'm joined today by Sam Savage and Matthew Raphaelson. Sam, do you want to introduce our new
Sure,
guest?
sure. Matthew Raphaelson was my student at the Stanford Business School in 1991. He went on to become the CFO of about a $30 billion organization. And Matthew and I introduced probabilistic thinking, I think, as early as 94, and then
Right.
struggling
1994.
to continue way before the concept of probability management. He'll tell you a little bit about that. But Matthew is the truly hardened veteran in the war on averages, and so the three of us are going to discuss really what we call the role of the chief probability officer, and we're looking at the cover of the ORMS Today article on probability management. This launched the discipline of probability management, and there's a guy sitting there with a CPO hat, Chief Probability Officer. And so today's discussion will be, what is the responsibility of this person? Basically to enable coherent probabilistic modeling of an organization. And we'll show a couple of examples of that. And I think we should kick it off first with Alex, who's had a good deal of experience trying to be the CPO of an organization. And then let's hear from Matthew. And then I will go back to the sort of the things we did at Royal Dutch Shell in 2005 that kind of kicked this thing off.
Thanks, Sam. So first of all, a little bit of admin stuff. Quite a few people watching on LinkedIn. Say hello right where you're from. And don't forget, this is live. So this is your opportunity to ask questions. I have a question for Matthew because which I'll ask a little bit later, because I'm fascinated by how a CFO can juggle probabilistic thinking with his day-to-day activities, because in all of my experience, I found CFOs being the most difficult person. They have so much on their plate, and they're so concerned with deterministic world that I'm amazed that somebody could combine probabilistic or stochastic thinking with the role of the CFO. So I'm very, very impressed. But as Sam mentioned, that's pretty much exactly what I've been trying to do for the last 7 years in different organizations where I was head of risk. My kind of sole objective was to supplement existing business processes with probabilistic risk analysis. Whenever there was a choice or a decision or a forecast which had a lot of uncertainty associated with that, I would offer kind of our services in quantifying uncertainty to that business unit or decision owner or process owner. It was a fascinating exercise because most of the time the decision makers did not want us there, but sometimes we were quite successful. For example, it was quite interesting in HSE, which is your health, safety, and environment team. We were quite successful finding common ground with the environmental part of the team and helping them justify and calculate the environmental, like water pollution, air pollution, solid waste, risk exposure, and using that to justify significant capex investments. And we found no response in the health and safety side of the same team. And so that was interesting. So I think that's enough for the intro. And again, reminder to everybody who's watching us, do say hello. We will see your comments and ask questions. Maybe you can kind of throw some themes. Our overall message today is the future of risk management may be in the hands of chief probability officer. And we're going to discuss, what does that role looks like today and what could it look like in the future. Matthew, over to you. I'm like my number one question is how did it work? with everything that the CFO does? How does probability fit in?
Great. So Alex, before I get started, can you see me okay on my screen? I see a big black rectangle with my name on it. Just want to make sure.
No, you're perfect.
Okay, great. So Alex, what you're saying really is important. I think in the traditional world of if a traditional company with a traditional accounting focused CFO, and where the focus is on quarterly earnings and accounting results and audits, in that world, it's very hard. It's very deterministic. Sam has a whole module on the flaw of averages in accounting, but that's a different subject. The accounting world is just not there yet. However, when I started working at my organization, this was in the 90s, and the idea of becoming a data-driven organization was the hot button, and my company really was serious about doing that. And if you're going to take being a data-driven organization seriously, and you're going to do data and models, you've now opened the door wide open to include probabilistic thinking in that, and that's what we did, and that was my entree. And so one of the things I said is if we're going to have a slogan, our slogan is quantify everything. And that means get the data, capture the distributions, simulate, don't throw out the distributions if you're doing a regression, use the standard errors. And we just built that culture over many years. And I had a crack team of analysts to support me. That was one of the benefits with working with Sam, is I could go to him and saying, who is your top student that we should hire and add to the team? And so, we had people who were taught how to do this and who knew how to do it, and importantly, knew how to communicate it. And over time, we taught our senior line managers, who are not mathematicians, who are not statisticians, how to ask the right questions of the data and of the answers. And we built a pretty solid culture to run the organization probabilistic outside of the quarterly accounting processes.
Was there a specific maybe activity or decision or process that was your first kind of go-to that became the anchor for the probabilistic decision making?
Oh boy, is that the perfect question. And the answer is yes. And it happened. This is a story that, I'll tell it Sam. It's really Sam's story. I brought in Sam to start the process of teaching our line managers, the importance of this and what their role in probabilistic thinking was. And we started off with the drunk in the middle of the road and the flaw of averages. And at that point, my boss, who is an absolutely brilliant woman and who is really the person who made this happen, because you need to have the boss fully on board. She goes, "Oh my God, that's why we can never forecast our bonuses." And if there is nothing more linear than a bonus payment, where you get nothing until you hit a certain threshold, and then above that you get paid. And what that realizes, the entire field of performance management is you just can't do it without probability distributions. It cannot be done. I don't know how organizations must muddle through if they're not thinking this way. And we had a performance management culture, and so we built the entire performance management discipline. This, based on the notion of the flaw of averages and how to fix it, and that's one of the kind of things, is that performance management typically as a HR function in a lot of organizations, we ran as a finance function.
Yeah, and I like to mention that meeting when that happened, because everyone's heard me say this stuff is easy to explain. The hard part is getting anyone to understand it, right? Well. And then the next level above that is, and even harder, is getting the right person to listen to it. So when Matthew first had me in, we planned like a 2-day course. I said, oh yeah, by the way, I have to get 45 minutes in front of the bosses of all these people, because otherwise they'll keep saying, give me a number.
Right.
And this one extremely bright woman saw the drunk in the road and said exactly, Matthew and I were sitting there, oh my God, that's why our bonuses are messed up. Right. And you know, you think of, again, just to go back, 0, and then, oh, you hit this thing and you get this kink in the curve, that nonlinearity that makes it all work. And one other thing I want to mention is that at that point, Matthew started using, it was probably Crystal Ball or At Risk, one of those things, probably Crystal Ball.
Crystal Ball.
And so imagine starting there in the 90s, they are running a power plant with light bulbs in it. That's not probability management. Right? Oh, you want to read your book? Come down to the power plant. We have lots of light bulbs down here. So imagine how much easier it is today. But that was real experience, you know, of probabilistic management, absolutely in-house.
Yeah, we had no infrastructure, so it's exactly right. You know, it would be as though, you know, I had an analyst who was cranking a generator every time we needed to run a crystal ball. You know, to do it was a lot of one-off models, but you know, we learned more and you know, developed more infrastructure over time.
My first stochastic strategic model took, I think, 24 hours to simulate 10,000 scenarios. And so we would leave it overnight and then pray that it didn't break.
Right.
Because it often broke, and then you're stuck for another 24 hours.
Yeah.
Well, luckily we are in the future now.
Yeah. So chronologically, it was well after that we did the first work with Royal Dutch Shell, which is the first time something qualified for probability management. And we started using that term. And so I think I should show that application, because that was kind of the breakthrough. That's what the screen you showed before is an article in ORMS Today about the work we did at Shell. It's on the publications page at the website. And we have a sort of make-believe model that goes along with it that's also available on the website. But here's the story at Shell. An incredibly fortuitous opportunity for me. I had colleagues at Cambridge University who were working with Shell, and so Shell could simulate the daylights out of an exploration project. But they could not, because they were too big, they could not assemble them into a portfolio. They could not add up the uncertainties. And by the way, I had already been working with a wonderful guy named Ben Ball in this area. He was the guy, there's a chapter about him in my book, in The Flaw of Averages. He was the guy, he had gone to MIT, he had been like a vice president of planning for Gulf Oil, which doesn't exist anymore. And he was saying, when people look at places to explore for oil, why don't they use Markowitz portfolio theory? And anyway, that started me down this path. It was just a wonderful opportunity. So Shell, and we had already figured out now how to do this with what's known as stochastic optimization. And I'll show you the pieces in a second. So Shell could pick these individual projects, but they couldn't add them up. Now, what if you're now looking at a dashboard and in this dashboard, this thing in particular is the risk of my portfolio. This is the average return of my portfolio. The blue dots are within budget. The yellow dots are not in budget. And if I crank this up to say 70, a bigger budget, oh, the blue line moves up. Notice how important it is to be interactive. And I will say that at Shell, the people using the real version of this dashboard, which was much bigger, were 2 steps below the CEO. So let's take a look. I have a bunch of projects. I'm going to call one Nigeria. I'm going to call one Nigeria 2. These have the biggest average return. So let's pick one of these. Click, and the green dot moves here, which means I'm looking at that particular project, but the dots are portfolios. So if I say, well, if I could have 2 projects, I'll pick both Nigerias, click, takes me way over here. Oh, why is it so risky? Because there's a chance that Nigeria will blow up politically. Okay, so let me back off both Nigerias. Let's pick Alaska. Alaska in, Alaska out. Now, it turns out that Alaska and Nigeria are completely independent. But then we've got Norway, which is not independent. Norway, if Nigeria blows up politically and loses their market, Norway will rush in to fill that gap. So Norway in, Norway out. Oh my gosh. Norway by itself is a dog because those socialists take $10 off the top of every barrel to have healthcare and education and stuff we don't want to subsidize. But boy, if Nigeria ever goes down, then Norway is a phenomenal hedge, right? So, oh my gosh, I could take on maybe both Nigerians in that case. But now notice the blue line here is what's critical. The blue line is the efficient frontier. So you would be nuts to pick a portfolio in here because I've got one over here that has less risk at the same return. Click, and it says, oh, you got Venture 2, Nigeria, Norway, blah, blah, blah. And then, oh, you want one with more return but more risk? Then you click up here. Okay, click. So what was this driven off of? It was driven off a set of coherent, statistically coherent, I'll explain that in a second, Monte Carlo trials on which we did stochastic optimization. So it's important for people to understand that the idea of sips and slurps were not mine. The names were mine, right? It's the person who names something that gets remembered for inventing it, but not at all. Let me make sure you understand what these are. We use this word coherent. We were able to simulate the projects individually. That's what each column is, which each column is a set of simulated outcomes, and I named it SIP, Stochastic Information Packet. These are coherent in the sense that here I have global uncertainties, which I like to call the winds of fortune. And if world oil price on this trial is $26.04, then it is that price for everybody. And if Nigeria blows up politically, which is this thing over here, then it blows up for everybody. And in particular, we see that the 2 Nigerian projects lose 230 million, but Norway goes through the roof. So when we initially thought of this, started doing this whole project, we were going to call it coherent modeling. And the reason we didn't call it coherent modeling was that coherentmodeling.com was taken, but probabilitymanagement.com wasn't taken, or .org. And so that's where the name came from. So that is kind of the origin. Now, this was after a lot of experience with Matthew, by the way, and I mean, a lot of stochastic experience. But this was the first time that really you would generate this in one location. And long before I invented the term sip and slurp, people were generating these things for use in optimization models, stochastic optimization models, right? You would generate that separately. You could have different people doing it in different platforms and then sending them in to what we're going to call the chief probability officer. Now, the chief probability officer has got to get this stuff right over here, right, to maintain the coherence. So that's the introduction to the shell model.
And this raises a very important point, because I'm sure many of our listeners came across that usually risk managers don't have the monopoly on modeling within an organization. So it's actually quite common for different teams within the organization to conduct different models, only to discover that they often use different assumptions, and not only just different assumptions, but also different values of those assumptions, or different probability distributions of those same assumptions, which creates all sorts of confusion for the decision makers. But more importantly, it makes it impossible to add the conclusions from different exercises.
So let's stop right there. That is such an important point. So the worst of all worlds, use averages. Okay, one step up from that. Okay, we're all doing our own oil exploration projects, and we're all going to assume log normal distributions for the price of oil. But wait, we've got different mu's and sigmas for our different shapes of our log normal. No, that's horrible. Okay, step up from that. Oh, we're all going to use exactly the same log normal distribution of oil price. Not enough. That's not enough. Because on trial one, Alex gets $100 a barrel, I get $50 a barrel, and Matthew gets $75 a barrel. That is incoherent. What's critical is that we all use 31.57 on the first trial, 32.38 on the second trial, and so on. That's the only way we'll be able to add these up at the end of the day.
Your microphone is off.
Matthew, you're muted.
Here we go. It can even get worse than that. And when you're in the risk world and you're looking at tails, we had an example is at a financial institution, and they're, the regulators were looking for the 95th percentile worst case, and you had two different analysts asking questions. So in an incoherent way, they asked what was the 95th percent worst case for checking accounts balances, and then somebody else came and said, well, I want the 95th percent worst case for CD balances. We're saying, what are you going to do with that? So we're going to add them together and say you can't, because the 95th percentile worst case for the first one happens when interest rates are high, and the 95th percentile worst case for the second one happens when interest rates are low. So they are not coherent, and they didn't understand that. So for all we know is they went off and added those two numbers together, and that doesn't even work in parallel universes.
Yeah, right. Exactly.
They would have actually been better off just using the averages at that point.
So this is what Matthew calls the flaw of the extremes, right?
Mm-hmm. Mm-hmm.
And there are a whole ton of those as well. But that is such a hilarious example. And people can get it. You can't, even if they happen under the same circumstances, you can't add them together. You can never add percentile, but in that case, it's even nuttier.
Right.
And I know, Alex, you were talking like last time about beginning to get people to use ranges of commodity prices and stuff. And you see, so that gets us to the real issue here of the chief probability officer. How do you model these things coherently? And so I want to make some suggestions. Number one, imagine, Alex, you're looking at 12 commodities, right? We've got, I don't know, potash, we've got fuel oil, we got all these things.
Yep.
So with 12 of them, if you had a full covariance matrix, that would be, 144 things. Well, actually, half of that because it's symmetric and, whatever. But that's a lot of things to work out. And remember, what we're following here, we are following in the footsteps of Harry Markowitz and the efficient frontier. Just to remind you, if I'm over here, why would I want any portfolio over here when I can go over here and have less risk at the same return, or I can go up and get more return at the same risk? So this is Harry Markowitz's concept. How about over here? You can't get there because it's impossible, because the efficient frontier is the mathematical optimal position. The only thing that's over here is like Bernie Madoff's fraudulent portfolio, and that's how they caught the son of a gun, because someone saw him over here. Okay, so we're really falling back on this notion of modern portfolio theory. And all our decisions need to be built around that. And so going back to Markowitz modeled the stock market as, okay, I've got, in 1952 when he did this, I think he was able to do 12 stocks or something. And then if it was 12, then it was a 12 by 12 matrix of covariances. And he tried to do 26, and the computer in 1952 couldn't do 26 stocks. Okay, but if you did thousands of stocks, then my covariance matrix is 1,000 by 1,000, it's 1,000,000. Yikes. Then came Harry's protege, Bill Sharp. Bill Sharp is famous for something called the CAP-M model, which is known as a factors model. The simplest version would be this. Yes, I have 1,000 stocks. Let us model them as completely independent of one another, except for the fact that they're all tied to, say, the S&P 500. And in fact, if you ran a regression of the change in the change in any stock versus the change in the S&P 500, you'd see a line sloping up. And the slope of that line is known as the beta of the stock, the degree to which it is tied to the S&P 500. So what if we just look at the stocks and their uncertainties? So I have a matrix of 1,000 by 1,000. Down the diagonals, I have the variance of each stock. And then I have only one other row and column, and it's like the beta of the stock against the market or the S&P 500. So instead of having 1,000 times 1,000 or 1,000,000 covariances, I have 1,000 diagonals and then one off and then one row. So I go from 1,000,000 to 2,000. And is that perfect? No, I mean, all models are wrong, said George Box, but some models are useful. That was very useful. But you don't have to stop with one factor, the S&P. How about two factors? One factor is the S&P, one factor is energy prices. And it gets a little more complicated. So what we had done at Shell was these were our factors: world oil price, gas price in 3 different regions, because gas prices tend to be independent. World oil price is one price. Why? Because you can put it on a tanker and take it anywhere else, and the cost of shipping is so low, it's basically the same price. Gas has to go through a pipeline, which may or may not exist, and there are costs associated with shipping, and so the regions are different. And then does Nigeria blow up? So that, you want to be CPOs out there, you have to start thinking of what, what's known as, I think factor analysis or factor modeling.
I have a story on that, because early in my career, when I was the head of risk, I had first one quant and then two quants, so quite a small team, and that would make it almost impossible for me to get involved into different decisions and model them all ourselves. So even though some of the business units wanted just that, they wanted us to come in, build the model, simulate, give them the kind of the results in Word as text, conclusions, and leave. And so I started kind of building calculators and finding people within the company that are capable of modeling, that have the competencies, because most CFAs are more than competent to build any kind of financial model, a stochastic financial model. And then the challenge came in, is that once you start giving up the responsibility for modeling, and different pockets of modeling expertise develop in the company, you have to have that consistency across the model, so you can aggregate them, you can compare results from different models from one to another, and somebody has to take responsibility for maintaining that central kind of piece of inputs, the assumptions, and a risk manager, I think, is perfectly positioned. And I'm interested in hearing what our participants are thinking, because I can see that there are at least 20 people watching us right now, most of them on LinkedIn, and they're very shy, because nobody even wants to say hello. For the first time ever, we've been doing this for 10 weeks now.
Yeah.
So don't be shy. Let me know, let us know what you think, because our hypothesis is stochastic modeling is going to be more and more commonplace in organizations. Basically, for any significant decisions, I would hope there is some sort of stochastic modeling, as more and more people in organizations realize the dangers of law of averages. But once that happens, the next stage is somebody needs to step up and say, I will be the custodian of some of the assumptions, so we can then have consistency across the organization. And a risk manager or chief probability officer could be that.
And while we're waiting for the people to chime in, so I do have another example. The Shell example is written up in the Flaw of Averages, my first book on this real subject. And then I did another one of these things with a pharmaceutical company that's written up in the Chancification book. And so just like Shell, these people were able to, and it was a pharmaceutical doing R&D projects, very much like drilling for oil. The drill breaks, it doesn't break. You hit oil, you hit gas, blah, blah, blah. And more shock than shyness, says Aaron. So they could, and they were simulating a couple of hundred drug projects. They had what are known as small molecule drugs, which is like aspirin and stuff like that. And they had large molecule drugs. What that means is like a biologic where you grow it in a vat. And they said, but we don't understand how to model our portfolio. I said, well, wait a minute. That's what probability management is about. Probability management, I finally defined the term 20 years after, or 10 years after I came up with a name. It means representing uncertainty as data that obeys both the laws of probability and the laws of arithmetic. And so just showing this again, we're representing the uncertainties as coherent vectors of Monte Carlos. And if you add two vectors together, well, you get the vector of the sum of those two products in a portfolio. So anyway, so back to the pharmaceutical company. First, they contacted me and they said, I think we might be engaging in the flaw of averages. Could you help us? I said, okay. And so this was their question. This is the way it kind of panned out to begin with. So I want to, let's see, I need to page down. So they had this big portfolio of R&D pharmaceuticals. And remember, it's a long tortured path. The drug kills the rat or it doesn't kill the rat. If it doesn't kill the rat, then you start trying it on humans and, all this stuff happens. And eventually, if you're lucky, you get a successful pharmaceutical. And the graph we're looking at here is the distribution of the revenues from successful drugs. That is, they made it all the way to the market. And notice that the bulk of them don't earn anything. The revenues are zero. And then you got a couple out here like Viagra and Lipitor that make billions and billions and billions, but the average was 1 billion. And this is all make-believe data, but it's roughly something like this, right? And their original question to me was, so we're looking at our portfolio, and does it make a difference that we're using the average here instead of the distribution? Now, actually, if you're summing enough things, the central limit theorem, this is not where the strong form of the flaw of averages applies. If you were summing up 1 million drug projects, then presumably you could use the average revenue. But they had 200. I said, well, we'd have to build a model to find out if it really has an effect at this degree of diversification. So what we ended up doing is they already had, I think they were crystal ball models. Now, we ended up taking the models, we ran them in something called, there's this analytic solver from Frontline Systems, very, very powerful interactive simulation. And this was before the magic of the data table, where we could do it really any other way. But they had a bunch of other questions, like what would happen under different discount rates? What would happen under this, under that assumption? So we ended up running, it turned out the simulations didn't converge until we got to 5,000 trials, and we had 200 drugs, I think, and then 5,000 times 200. I don't know, Matthew, maybe you can do the math. But then
sounds like 1 million to me.
Fine. And then we had 64 different experiments we were running. I think, and it wasn't 64. So we ended up with a database of, it was more like 30 million numbers because we had to do all these different. Let me just show you one experiment. So think of a design of experiment. We'll do each one under the average assumption or under the full distribution of revenues, right? Assumption one, every successful drug earns $1 billion. Assumption two, we draw from the distribution of successful drugs, the revenues. So, just to take, it's all make-believe data, but suppose we had an NPV target of $5 billion and we see a 49% chance of achieving our target. See this little radio button? That's using the $1 billion average. Now let me click on the full distribution. Click, what was that? That was another million, 5,000 times 200, a completely different library now, right? So, but the library was run already, right? So I'm just swapping in that library or that library. Okay, now, can you tell the difference between that and that? Oh, what happened to our chance of achieving the target? 25%? Let's go back. 49%. Can you tell the differences in the picture? Okay, now close your left eye. That or that. And so a couple weeks ago, John Button of Gartner was on the show asking questions and came up with another lame excuse for not modeling uncertainty. So, well, when you aggregate a whole bunch of things, you always get a big flat distribution. No, not if you do it coherently, because your drug model assumption sweeps through all the drugs at once. Now, let's go to the full distribution. And I want to point out another amazing thing that happened. There were two other amazing things. And I mean, we might want to stop here and wait for comments, because a friend of mine says a successful model tells you something that you didn't tell it to tell you. And this model absolutely did that, and it just knocked our socks off. But any questions before we continue?
We have quite a few, and I don't know, Matthew, did you want to add something on the previous point as well?
Yeah, I just wanted to, your point on, how you start this process of building the Coherent Chief Probability Office.
Yeah.
And for us, I started out saying, it was me and my team, and because it was just that, it was Coherent. After a couple of mergers and the company grew by a factor of 10, all of a sudden we had a distributing modeling environment, just like what you discussed, Alex. And you start very basic. We started to lay out rules such as, okay, everybody's model, you have the time period is in the top row, and the direction of time goes from left to right. Your organizational accounts is in the left column, and they must be in ascending order according to account number. Just basic things like that, because you'll find that everybody's model does it differently. And that's the first thing that blows up your coherence. Forget about stochastically, just even in a deterministic world, is when a cell is actually a completely different type of data in every model. And so you literally have to start out with very basic rules about how your models are structured. And then it builds from there. You start to say, okay, well, now what are your organizational hierarchy rules? And then once you've sort of got that into people's minds, if there's rules about this, everyone can't just design their spreadsheet or their Python code the way they want to. Now, at least you can start to think about the more daunting task of how do you organize your stochastic libraries. But I just wanted to make that point there. You literally have to build it from the ground up.
Yeah, that's a very good point.
Absolutely. And I think
yeah.
Both Matthew and I believe there's just a huge opportunity now, basically in consulting, to help organizations build out their chief probability office. They haven't done it. It's like when Westinghouse and Edison started delivering electricity in 1895. There was a huge opportunity to help factories electrify, right?
Yeah, and part of the opportunity is, I think, is the enlightened person in the organization can just start doing it. I mean, I wasn't at the the C-suite level. I wasn't the CFO of the entire enterprise, CFO of a line of business. I just started doing it because somebody had to do it, and then at some point, if it made sense, you move it to the Treasury Department or the Chief Risk Office or the things like that. But that I just say somebody just start doing this stuff.
Right.
Because,
Now
because nobody else is, so you might as well do it.
So I want to respond to Malcolm here. There was a two-part thing. Let's see. Okay, getting consensus on a stochastic loss function within the organization. That's huge. And then we're talking about the mean variance model. Right. So probability management offers the chance here to deliver the full multivariate probability distribution to everybody in a transparent form, because you're just talking about like financial risk. Matthew and I are working on a project that involves safety risks in California utilities, and you've got financial risks, you've got safety risks, you've got reliability risks. And why did Harry Markowitz start with mean and variance? So it was 1952, and variance is all he had. And by the way, he assumed people had a logarithmic utility function, and variance gave a good fit to the Taylor series. It's way more than mean and variance. And we do want to look at the full distributions. And we want to look at the whole multivariate thing, because in reality, your decision is not just going to be, according to Malcolm's questions, how do we get a coherent risk attitude in the organization? It's a huge issue. We need for people to understand what risk means. It's not so easy, but it can't just be one-dimensional. And this will be, by the way, the subject of our next Chance talk. Well, we got a bunch of things, but let's make sure we put this on the agenda. I've got a model that shows risk contours in the electric utility context. You've got how much money are you going to spend on mitigation? You've got how much safety mitigation are you going to get? You've got how much reliability mitigation are you going to get? And we want to show the entire set of trade-off curves to the management. They're all going to have different risk preferences, right? And so it's maybe harder than Malcolm is suggesting, because we're not just going to look at mean variance at all. I think that is a very primitive way to look at it, but it was great in 1952, absolutely great. I want to quote G.K. Chesterton, British author, who said, "If something is worth doing, it's worth doing badly." And frankly, Harry Markowitz did it brilliantly, but it was just opening the manhole cover to see what was underneath, right? So I think we're probably about out of time here.
Yeah, we have about 5 minutes. 5 minutes left.
What I might do is then show this shocking discovery.
Yes, please.
That this model brought us. One of the things we would look at here is discount rate. Very important, because the drugs last for a long time, and then the patent runs out. All right. So we had all these different discount rates. Another thing we had was sort of the success level of the drugs. All right. And early on, it was like shortly before we had to deliver the model, a success level, it's a little hard to describe. There's this long tree. It kills a rat, it doesn't kill the rat. It cures a rat, it doesn't cure the rat. It cures a human, it doesn't cure the human. Da-da-da-da-da. We get to phase 3 trials. And now it's, efficacious on large populations and blah, blah, blah. Well, we could not vary each of these probabilities in the tree, but what the pharmaceutical company said is, we're going to give you various levels of success in terms of a whole ensemble of probabilities. So we'll have a probability of success level 1, where the number of drugs that make it through is like very small. And then we'll crank it up level 2, level 3, level 4. Well, so we're sitting there, and I go from probability of success level 1, where on average I lose $83 billion, to, oh, we'll make the drugs more successful. What? I lose $139 billion because the drugs are more successful? Oh, no. And we thought, oh, my God, we got to deliver the model tomorrow. We're dead. But thank God it's auditable. We went back through the SIP library. Oh, no, I'm sorry. That's true, guys. That's the truth. What we discovered is the following. What is the worst thing that can happen to you? That you make it all the way through very expensive phase 3 trials, and then it turns out it kills the human at the end of that. That's a disaster. Well, look at my discount rate. I'm at a very high discount rate. So what happens is, the worst, if you increase the overall success of these drugs, then under a high discount rate scenario, when the worst of all worlds happens, is I make it all the way through phase 3 and then I kill the human, I lose a tremendous amount of money right away. On those trials in which it's successful, and I get revenues over the next 20 years, the 20 years of revenue doesn't matter anymore because I got a 17.5% discount rate. Holy Toledo. That was a dimension I hadn't seen. And maybe that was the day I woke up and started smelling, what CFOs really worry about. But it was shocking to me. And, you get to the lower discount rates and those sorts of anomalies go away. So that's the story of the model that told us something we didn't tell it to tell us, which was in fact the truth and which we should have been worrying about.
Malcolm is asking a follow-up question. I don't know if we have time for it now. It will be our opening question.
Yes.
Next
well,
week.
No. But what method is available for estimating distributions? Metalogs, for God's sakes. The metalog distribution. Malcolm, have you studied the metalog? We're going to have Tom Keelan on the show.
Yep. To
discuss metalogs. The metalog is the Taylor series of probability distributions. It's a game changer.
All right. Any final words? Because we do have to wrap up for today. Any final words, Matthew?
All good.
Excellent. Any final quick questions? Yes, Sam, please.
Well, we need a title for this show. It's like, this is, what is the CPO supposed to do? What is a chief probability officer? We've just kind of cracked the door on this. And it's early innings in the whole field of probability management. So I think we'll probably be having additional shows. Matthew is working on sort of he calls it the CFO's toolkit to use in this environment. How does the CFO use this information to make decisions? And so I think we'll be discussing that in future.
Yeah, I think we can go into more detail of, if you're designing a chief probability office, what are the roles and responsibilities of it? And, I've kind of thought that through. And then once you have it, how do you use it to drive the organization forward?
I mean, that sounds so fascinating that I'm kind of looking forward to the next conversation, because I want to know as well. I think I was kind of just discovering and just making it up as I went when I was trying to do something like this. Again, very much inspired by what Sam was saying, because if you watched, and I'm talking to all the participants, if you watched any of Sam's sessions from 2019 Risk Awareness Week, well, that was ages. Well, that's exactly what Sam was talking about creating SIPs, virtual SIPs, basically centralizing the probability management within the organization. And now we're just saying, let's put a person on top of that centralized probability management within the organization. Thank you, Sam. Thank you, Matthew. And
Bye-bye, Alex.
thank
Thanks,
you
everybody.
to everyone watching us. See
So
you. Maybe not next week because I'm traveling next week, but the week after, definitely.
Terrific. Looking forward to it. Bye-bye.
See you soon. Bye.